There's this question in investing that seems so simple on the surface, but man, it can spark an absolutely fierce debate. It's all about dividends. Are they this amazing, reliable source of income? Or are they just kind of like a clever illusion? Today, we are going to dive right into the heart of this great dividend debate and figure out if it's a myth or if it's really all about your mindset.
And this is the question that kicked the whole thing off. A user on Reddit posted this, and it just ignited a firestorm of arguments. And at its core is this paradox that makes a ton of people just scratch their heads. I mean, if you get paid a dividend, but the stock price drops by the exact same amount, did you actually make any money?
So to really get why people are so skeptical, we have to start with some super simple math. We're going to call it the $50 question. And it is the absolute foundation of the whole dividend myth argument. It feels like basic accounting, right? But as you're about to see, the market doesn't always play by the textbook. Okay, so this slide just lays it out perfectly. On the left, you've got one share of stock worth 50 bucks. Your total value is 50 bucks. Simple. Then on the right, the company pays out a $1 dividend. Now the stock price drops to $49, and you've got $1 in cash. Your total value is still $50. So if you're not any richer, what gives? Where's the income?
Okay, but here's the thing. That clean, simple math, that's where the textbook closes, and the messy, unpredictable reality of the stock market begins. A stock's price isn't just about the cash a company has on its balance sheet. Oh no, there is so much more going on under the hood. That whole $50 paradox thing is rooted in this idea of book value. It's basically the on-paper accounting value of a company. So when a company pays a dividend, it's sending cash out the door, which lowers its assets, and yeah, technically lowers its book value. In a perfect, sterile lab environment, the stock price would drop by that exact amount. But let's be real, we don't invest in a lab.
And boom, here it is. This Reddit user absolutely nails the counter-argument. The market doesn't trade on book value alone. It trades on perceived value. It's about what people think the company is going to earn in the future. It's about sentiment. It's about the brand. It's about 1,000 things that you just can't neatly capture on a balance sheet. So why does that $49 stock often seem to climb right back to 50 bucks or even higher pretty quickly? Well, it comes down to three big reasons. First up is just psychology. A lot of investors see that little post-dividend price drop as a sale, a buy-the-dip moment, and they rush in. Second, there's a huge group of investors whose whole strategy is built around finding income, so there's always this built-in demand. And maybe most important of all, the market is always looking forward. The cash paid out today is often seen as way less important than the profits the company is expected to rake in tomorrow.
All right, so keeping all that market messiness in mind, let's switch gears and look at why so many investors will go to the mat for their dividend strategies. For them, it is not some forced sale of their own money back to them. No, it's a fundamental piece of their entire investment philosophy.
You hear this one all the time, and it's probably the biggest argument in favor of dividends. That dividend check is a realized cash-in-your-pocket gain. You get to tap into the company's profits without actually selling off any of your ownership. You still have this same number of shares you had before, but now you've also been paid. It feels more like you own a business that sends you a check every quarter instead of just owning a piece of paper you hope to sell for more later on.
Now, this is a fascinating point. Some investors see dividends as a way to keep corporate management honest. Think about it. Every dollar they have to pay out to you is a dollar that executives can't spend on, as one user put it, moronic buybacks or projects that just, well, light money on fire. It's kind of a way of saying, hey, just give me the cash. I trust myself to invest it better than you might.
And here's the big psychological comfort. When the market is absolutely tanking and your portfolio is just a sea of red, that quarterly dividend payment can feel like a lifeboat. It's this steady, predictable stream of cash that doesn't care about the day-to-day panic of the market. It gives you a real sense of stability when everything else feels totally out of control. But how guaranteed is it, really? Because here's the crucial reality check. That so-called guarantee has a pretty big asterisk next to it. Dividends get paid from profits, and if a company hits a really rough patch and those profits dry up, that dividend can be, and often is, slashed or cut out completely. Just ask anyone who was holding AT&T stock a while back. Ouch. What feels like a sure thing can vanish right when you need it most. All of this really points to a much bigger truth in investing. This whole dividend debate is just one chapter in a much larger story, and the theme of that story is simple. Generating income always involves a trade-off. There is no free lunch. To get that cash in your hand today, you almost always have to give up some potential for growth tomorrow. Let's use another popular income strategy to really hammer this point home: writing covered calls. Okay, in simple terms, you own a stock and you sell someone the right to buy that stock from you at a higher price. In exchange for making that promise, you get paid a chunk of cash, a premium, right now. You're basically putting a ceiling on your potential gains in exchange for immediate income.
And wow, this data from ProShares shows that trade-off in really stark terms. Look at this. Over 10 years, a covered call strategy still felt 84% of the market's losses. So it didn't give you much protection when things went bad. But on the flip side, it only captured 65% of the market's gains. You're giving up more than a third of the potential growth.
And this is what that can look like in the real world. During that insane COVID crash and the lightning-fast recovery that followed, the S&P 500 basically clawed its way back to break even. But an investor using that covered call strategy, they would have been stuck down about 13%. They just missed out on too much of the rebound. It's a powerful, real-world example of that no free lunch rule.
So we've looked at the simple math, we've heard all the passionate arguments from both sides, and we've seen the trade-offs in action. So, where does that leave us? What's the final verdict? Well, it turns out the answer isn't about numbers on a spreadsheet. The answer is actually about you. I love this quote from the Looney Doctor because it just cuts through all the noise and complexity. The dividend debate isn't about which side is mathematically right or wrong. It's a choice. It's about you consciously saying, I am prioritizing income right now over the potential for bigger growth later. Neither one is better than the other. They just serve totally different goals. So to figure this out for yourself, you really got to ask yourself some tough questions. What's your priority? Is it getting those regular, predictable cash payments to pay the bills? Or are you focused on deferring taxes and deciding for yourself when to sell? Do you trust a company's management to reinvest those profits better than you could? It all comes down to what you need now versus what you're trying to build for later. And that brings us all the way back to where we started. So is dividend income a myth? Well, after looking at all the angles, it seems like the income itself is very real. The free money part of it, that's the myth. The income comes at a cost, and that cost is potential growth. So no, it's not a myth. It's a mindset. It's a choice you make. Ultimately, this whole debate isn't about who wins a math argument on the internet. It's a mirror that forces you to ask one of the most important questions in all of finance. What do I want my money to do for me? Cash in your hand today or potential growth tomorrow? Your answer to that question will tell you everything you need to know. Thanks for digging into this with us.